Hello, this is Jared with the Helton Group at Loan Depot, and this is our second in our WTF series, What the FICO, and we're going to talk about why should you even care. And you should care because your credit is going to make up your points and your fees and your interest rate on your loan. And different products have different ways that will do it, but it really has a big impact. So whether you have good credit now or if you have credit that you need to improve, it will make a difference in your loan. So the different products will have different ways that it benefits you. So on a government loan, which is FHA, VA, USDA, every lender might have a different minimum credit score. Ours here at Loan Depot, most of those products is 580. Some companies have higher ones of 620. So on those, it's not, those are going to be a little bit different company to company. So if some company has a pricing hit at 680 FICO score, let's just say it's 50 basis points, on a $300,000 loan, that means that loan is going to cost you $1,500 more, or you're going to get an eighth to a quarter higher in payment or in rate, which is biggie, $20 to $40 higher in payment. Our pricing breaks don't come in until 620, so a little bit lower, which is helpful, but still it has a pretty big impact. On government loans, one of the advantages is the upfront costs. So on upfront mortgage insurance, really it's called the funding fee on VA or the upfront on FHA and the monthly, it's all the same. Whether you have an 800 credit score or 620 credit score, it's the same. So that's kind of an advantage. On jumbo loans, FICO score really comes into play because the larger your loan, which jumbo in most states is over 510, 400, you really need to have a higher credit score for that, and it could impact how many reserves you have. So that's the money you have left over after you close your loan. So then on conforming loans, it makes up the biggest difference. So on conforming loans, most lenders follow Fannie and Freddie, which is the 620 minimum credit score, but they have what's called loan level pricing adjustments. So if you have a higher FICO score, they're less. If you have a lower FICO score, they're more. If you have a higher loan to value, they're more expensive. The lower loan to value, they're less expensive. I mean, that's a simplistic version of it, and it's kind of a graph. But to give you an example, if you have a 719 credit score, that loan compared to a 720 credit score would cost you 50 basis points more in fee. So again, on a $300,000 loan, that 1 point will cost you $1,500, or your rate of interest is anywhere between an eighth to a quarter higher. It would cost you $20 to $40 more in your payment. So that's a pretty big deal for having 1 point. And then another example would be of a mid-range credit score towards lower credit score. If you have a 659 credit score versus a 700 credit score. Same example, 80% loan to value on a $300,000 loan. That loan would cost you $6,750 more if you paid it in fee, or in rate. Your rate could be as much as a point higher on that. On that same loan, it's going to cost you about $168 more a month. That's a pretty big difference. Plus on conforming loans, if you're above 80% loan to value, you also have what's called mortgage insurance. Mortgage insurance is very much based on your FICO score. So I just did one example on that, but the difference between a 719 and a 720 credit score, it's going to cost you $17 difference in your monthly payment for that 1 point. So that 1 point between 719 and 720, that could cost you $50 to $60 more on your payment, or it could cost you quite a bit on fees. So it's really important to think about that. I want to thank you for watching video 2 in the WTF series, What the FICO. Hopefully I can lend you some more knowledge in the future. And you can always DM me or call or text at 541-870-8913. I look forward to helping you in the future. And stay tuned for our third in the series, What Makes Up a Credit Score, and that will be out soon.